Most people think oil is about gasoline. That is too small. Oil is not just what you pump into a car. Oil is what moves the whole machine. It moves food, it moves freight, it moves ships, it moves planes, it helps make fertilizer, it sits inside plastics, it sits inside chemicals. It sits inside the hidden plumbing of the economy in a way most people never respect until the flow gets interrupted. And by the time they do respect it, the damage is already moving. That is what I think is happening now. The public is watching the wrong screen. It is staring at the paper market and assuming the paper market is still telling the truth. I do not believe that. I think the physical world is already saying something much uglier. And the paper world is still trying to calm people down long enough that the rest of the financial system can keep pretending everything is manageable. That is the first thing I want you to understand. This is not only an oil story. It is a truth story. It is a story about what happens when quoted price and lived reality stop agreeing. I have seen this kind of split before in other forms. People trust the easy number. They trust the clean headline. They trust the official reassurance. Then later, when life gets more expensive and the explanation arrives too late, they act shocked. I am not shocked because whenever the paper world calms down faster than the physical world heals, I assume somebody is lying. Maybe not with words, maybe with timing, maybe with price, maybe with both, but somebody is lying. And if you do not understand that, the next stage is going to confuse you badly. You are going to look at a rally in the market and wonder why the cost of actual life keeps rising. You are going to hear that oil is only trading around one number, and then find out the real delivered barrel costs something very different. You are going to hear inflation is under control and then watch transportation, food, and the basic act of being alive become more expensive anyway. That confusion is not random. It is what happens when the public watches the surface while the real pressure is building underneath. That is the whole setup. The source document puts the split very clearly. It says the paper price of oil, the futures price most people see quoted, sits around one level, while the physical price for a real barrel delivered to a real refinery is much higher, with a spread of roughly $35, described there as the biggest such gap ever recorded. Fe-Filicite Fe-Turn 51 File 0 Fe, that is not a small detail. That is the story, because for years those prices moved close enough together that most people could pretend they were cousins. Now they are speaking two different languages. One language is meant for screens. The other is meant for people who actually need the barrel. That is a very serious difference. The futures market is what the public sees. The physical market is what industry feels. And industry always wins eventually, because you cannot run a refinery, grow food, move freight, or power a supply chain with a quote on a screen. You need molecules. That is why I keep coming back to the same phrase, you cannot print physical atoms. That is the line the paper world always runs into sooner or later. Promises can stretch, narratives can stretch, paper contracts can stretch, actual barrels cannot. So when I see a large and widening spread between paper oil and physical oil, I do not ask whether this is interesting. I ask how long the paper market can keep pretending physical reality is not going to collect its invoice. That is the right question. Now let me widen the frame. A lot of people still think the United States is protected from all this because they have been told a flattering story. That story says America is the world's gas station, that it produces enough, that it exports enough, that because the conflict is over there, the pain will be over there too. I do not trust that story. The source document challenges it directly. It says the United States imports about 6.3 million barrels of crude a day and exports about 4.1 million, making it a net importer of about 2.2 million barrels a day in the framing of the source. Fe-Filicite Fe-Turn 51 File 0 Fe now. Whether someone argues about the exact framing of net imports versus gross product flows is not even the deepest point. The deeper point is simpler. America does not live outside the global oil system. It lives inside it. And when the global system is stressed, even countries with meaningful production still experience that stress through price, freight, refining mismatches, inventories, and the expectations of every participant in the chain. You do not get to live inside the plumbing and then pretend the burst pipe only affects other rooms. That is not how real systems work. That is why I reject comforting slogans in energy markets. Energy is too physical for slogans. What matters is flow. What matters is bottlenecks. What matters is how much is missing for how long and who feels the shortage first. That is why I found one part of the source especially important. It says the world uses roughly 100 million barrels of oil a day, and it frames the disruption as somewhere between 8 and 13 million barrels a day missing from normal flow. Fe-Filicite Fe-Turn 51 File 0 Fe, you hear that, and if you are not used to commodity scale, you may round it down. Mentally do not. That is not a rounding error. That is not a small inconvenience. That is a large injury to the metabolic system of the planet. The source goes further and compares the damage to strategic reserves, saying one estimate put total lost barrels over the course of the conflict around 780 million. While the U.S. Strategic Petroleum Reserve is far smaller and was already depleted relative to past levels. Fe-phthalosite Fe-turn 51 file 0 Fe. Now, I am not interested in using those numbers theatrically. I am interested in what they imply mechanically. If the world loses enough flow and spare capacity plus stockpiles cannot make up the difference cleanly, the shortage does not need permission from the narrative class to become real. It becomes real because a factory needs feedstock, a ship needs fuel, a farmer needs fertilizer, a trucking line needs diesel. That is why this story matters far beyond traders. A supply shock does not stay in the commodity section. It walks, energy goes first, transport feels it next. Fertilizer follows, food comes later. Then the consumer realizes the problem was never just oil. It was the cost of keeping civilization moving. That is the chain I want burned into your mind. Energy, transport, fertilizer, food consumer, bond market. Because yes, this ends in bonds too. But I am getting ahead of myself. Let us stay with the physical chain a little longer. The source makes an analogy from Interstellar that I think is useful, even if people hear it and smile. The world looks out and sees what appear to be mountains. But they are not mountains. They are a wave that is exactly how a delayed supply shock feels. At first, the visible system still looks normal enough. There are still prices on screens. There are still ships and databases. There are still official reassurances. There are still financial commentators joking about overreactions. Then one day the bulge reaches shore, and suddenly everyone starts saying the same thing. How did this happen so fast? It did not happen fast. It happened early. You just were not looking at the right place. That is what supply shocks do. They begin in flows, they become visible in costs, they end in behavior. Now let us talk about timing, because people always want timing. When does this hit? When does America feel it? When does the paper lie fail? The source provides a very specific timing logic. It says the last tankers that cleared before the closure become the final clean water in the pipe, and that once those pre-closure barrels are fully used up from the global supply chain, the buffer disappears and the physical and paper prices must converge. It marks that expected exhaustion around late April in its framing. Fe-phthalosite Fe-turn 51 file 0 Fe, whether the exact day lands like that or not, is less important than the sequence. The sequence is what matters. Pre-shock barrels keep flowing for a while. That creates the illusion of normality. Then those barrels are consumed. Then the system must live on the new reality. That is when the paper story becomes harder to maintain. This is what people hate about energy shocks. They move with a lag. The lag gives complacency room, and complacency is always strongest right before the physical world finally forces the paper world to tell the truth. Now, who feels it first? The source maps that too. It says Asia gets hit earlier and harder because of dependence on Gulf flows. With severe fuel disruptions and emergency measures already showing up in countries across Asia, Africa, Australia, and Europe. Before the full effect reaches the United States, Fe-phthalosite Fe-turn 51 file 0 Fe, that makes sense. Systems do not break evenly. They break in order of dependence, geography, and inventory resilience. Some regions feel pain first. Other regions use that delay to tell themselves they are safe. That is another dangerous mistake. Later is not safer. Later is just later. And later can be worse because the people who were later often use the warning window to relax instead of prepare. That is one of the oldest errors in macro-confusing delayed transmission with immunity. Now let us go back to the paper market, because this part is what really bothers me. The source raises the possibility that the paper oil market has been leaned on psychologically, describing repeated suspicious shorting activity around official announcements and arguing that paper oil prices may be serving as a calming mechanism, even while physical oil trades at a much higher delivered reality. Fe-phthalosite Fe-turn 51 file 0 Fe. I do not need to know every name involved to care about the mechanism. The mechanism is enough if somebody is selling paper oil at a level far below what physical users are paying, and if those promises eventually must be honored or bought back, then there is only so long that game can be played before somebody needs the barrel and the theater ends. That is what a short squeeze really is in commodity language, not merely price moving. Reality forcing paper promises to find real supply at whatever price the physical market now demands. The source says this directly too. It says that if contracts come due and the seller cannot deliver, then those positions must be covered at market prices, which can violently pull the paper market toward the physical market. Fe felicite Fe turn 51 file 0 Fe, that is the part I think markets are underestimating. You can suppress psychology for a while. You cannot negotiate with a refinery. You cannot calm a fertilizer plant with a press release. You cannot fix a diesel shortage by telling the SP 500 everything is fine. Eventually the machine demands the thing itself, and that is the moment when paper stops being a comfort device and becomes a liability. Now let us move from oil to food, because this is where the average person will finally feel the shock without needing to understand commodity basis or futures curves. The source points to fertilizer, specifically urea, and says prices are climbing again toward the levels seen during the 2022 food shock, explaining that this fertilizer depends heavily on natural gas, which is tied into the same disrupted regional flows. Fe file site Fe turn 51 file 0 Fe that matters. A lot of people think fertilizer is a niche agricultural line item. It is not. It is a downstream lie detector. If fertilizer prices spike, food prices usually follow later. Energy first, food second, then everyone acts surprised. No one should be surprised. The pattern is old. The reason food matters so much is that food inflation changes the political character of a problem. People can tolerate market losses with abstraction. They tolerate higher grocery bills much less gracefully. A bad quarter in someone's portfolio is one thing. A rising grocery bill is daily humiliation. That is when macro becomes social. That is when politics gets angrier. That is when central banks lose room. And that brings us to the bond market. This may be the most important part of the whole story. The source provides a chart framework of sovereign 10-year yields across major countries and highlights that while US, UK, German, and Japanese yields rose, Chinese yields fell, with the source interpreting that divergence as money moving differently in crisis than many people expected. Fe file site Fe turn 51 file 0 Fe. Now, regardless of how one interprets the full global capital story, one point is absolutely correct. The US 10-year matters. It is not just a market number. It is a master price. Mortgages, corporate borrowing, discount rates, valuations, the basic cost of money in the American economy. And the source says that if the US 10-year moves toward roughly 4.6% to 4.8%, debt servicing stress becomes much more serious given the country's enormous debt load. Fe file site Fe turn 51 file 0 Fe, that is what an oil shock does when it feeds inflation. It traps the Fed. If oil rises and inflation rises, cutting rates becomes harder. If cutting rates becomes harder, yields can stay high or rise. If yields stay high while the debt load is enormous, the debt burden gets heavier. That is how the debt spiral logic tightens. The source names it too. An oil shock can feed a debt spiral by pushing inflation up just when the central bank would otherwise want relief. Fe file site Fe turn 51 file 0 Fe. This is why I keep saying this is not just an oil chart. It is a bond market story. It is a sovereign funding story. It is a valuation story. And most of all, it is a false comfort story. Because the SP 500 can rally while the physical world worsens. That is one of the cruelest and oldest illusions in markets. The source compares past oil shocks, including 1973 and 1990, and notes that markets often stayed calmer than they should have in the early phase, only to reprice later as the reality of the supply hit worked its way through the system. Fe file site Fe turn 51 file 0 Fe. That is exactly right. The market does not always tell the truth immediately. Sometimes it tells the convenient story first, then reality arrives and takes the microphone later. That is why a rally in the face of worsening physical conditions does not comfort me. It warns me. It tells me the market is still pricing the story management wants, not the story the pipeline is writing. The source reinforces that with another divergence, the gap between the stock market and consumer sentiment, arguing that regular people already feel something much worse than what the market is currently discounting. Fe file site Fe turn 51 file 0 Fe. That also matters. Wall Street and Main Street can diverge for a while. They do not diverge forever at some point. One catches the other. And history has a nasty habit of showing that the man filling up the tank and buying groceries usually feels the stress before the broad index fully respects it. That is not because he is smarter. It is because he is closer to the physical world. Now let me tell you what I think the market is doing wrong here. It is treating the conflict like a headline problem instead of a transmission problem. Headline problems can fade fast. Transmission problems do not. A ship rerouted today changes cost later. A refinery short on feedstock changes output later. A fertilizer surge changes groceries later. A bond market forced to digest inflation stress changes financing later. That is why I say the real danger is not the headline itself, it is the lag. The lag is where the public sleeps. The lag is where financial television gets overconfident. The lag is where people start using the word contained. And then one day the lag runs out, and everyone pretends no one could have seen it. I dislike that kind of dishonesty. The physical world usually tells you first. You just have to respect it enough to listen. So what am I supposed to do with all this if I am an investor? First, I stop trusting paper calm when physical stress is still building. Second, I stop pretending that cash is obviously safe if another inflation wave may still be moving from energy through food and into yields. Third, I respect real assets and productive assets more than stories that require cheap money and frictionless supply chains to look healthy. Fourth, I think much more seriously about quality, pricing power, balance sheet strength. Real cash generation, the kinds of businesses that can survive in a world where inputs, transport, financing, and politics all get meaner at the same time. And above all, I stop believing that a green market automatically means the danger past. That is a childish belief. Green screens are not absolution. They are sometimes just the final stage of denial before the physical world reasserts itself. If I had to reduce this entire oil story to one brutal sentence, it would be this. The market is still trading the paper version of oil while the world is already beginning to live the physical version of oil, and eventually the physical version always wins. That is the truth, not because I enjoy saying it, because molecules beat narratives, because freight beats optimism, because fertilizer beats talking points, because bond yields beat political spin, and because in every serious commodity shock, the world eventually stops caring what the paper price wanted and starts paying what the physical shortage demands. That is where I think we are heading, not maybe mechanically. And if you understand that now, you have at least one advantage over the people still admiring the mountain before they realize it is a wave.